Hi guys, and welcome back to CashBright, your guide to investing in an ever-increasingly uncertain financial world. Snowflake has raised the largest initial public offering ever for a US software company, with many estimating that the IPO could raise the company an incredible $3.4 billion. Snowflake Inc. are a cloud-based data warehousing company, which enables businesses to access, explore, share, and essentially utilize the value of their data. The company is seen already as a key player in the cloud data sector and has ambitions to take on the current market leader, Amazon. Snowflake originally set a price of around $75 to $85 a share, but with a wave of feverish investor sentiment driven by the news that Warren Buffett's Berkshire Hathaway is also investing, they felt compelled to raise this to around $120 a share. For Wall Street, this is a heady mix of a growing company within an innovative area of the tech sector and with the seal of approval of one of the most respected and well-known investors around. Wow, I don't know about you, but all of this really gets your blood pumping. And I'm sure this is how many investors will be feeling about the IPO and the initial chance to purchase this stock. But let's not get carried away here and abandon our critical faculties in order to gratify the impulsive prefrontal cortex of our brains. Every investment decision ought to be as informed as possible. So, should we all be buying, dodging, or holding fire on this stock? Well, let's first consider the company itself. Snowflake is exciting to investors because it is the only company to currently offer customers software which runs on Amazon, Google, and Microsoft platforms. The software produced by the company offers customers flexibility and allows them to either scale up or down their usage, and with variable pricing structures to match this. Flexibility is the key here though, and gives Snowflake a USP, even when compared to the likes of the big three. They've also had very good revenue growth in recent years, with revenue growing around 175% in their previous fiscal year. In terms of IPOs, the company also has the largest net revenue retention rate of 158%. This revenue retention rate is important because it shows how much Snowflake's customers are continuing to spend on its products. Customer retention is vital for any business, as it is a well-known fact that it costs a company much more to gain new customers than to retain existing ones. To round off the positive case for buying this stock, the backing of both Warren Buffett's Berkshire Hathaway and Salesforce.com Inc. is giving investors a lot of confidence, not least because Warren Buffett is usually allergic to investing in IPOs and tends to favour investing in much more established companies. So we are beginning to understand the reasons behind Wall Street's appetite for this stock. But what about the negatives? Well, first off, you should know that Snowflake is loss-making and taking on some hefty competition in the form of Amazon, Microsoft, and Google. In the last fiscal year, Snowflake almost doubled its losses from $178 million to $349 million. Of course, any growth stock is going to incur losses before it becomes profitable, but still, this is something to bear in mind. Taking on the big three in this area is also a tall order for the company, and there is also an uncomfortable contradiction in the fact that Snowflake primarily uses Amazon Web Services as part of its product infrastructure. The company has committed to paying $1.2 billion on AWS over 5 years. Relying on a competitor's services may help you in the short run, but it goes without saying that this business plan is rather unsustainable if the company truly does seek to establish itself as a market leader. This is because, whilst Amazon make comfortable bedfellows for Snowflake today, the same may not be true when Snowflake really begins to make a dent in Amazon's cloud services revenue. So, will you be buying, dodging, or holding fire on this stock? With so much demand and the likelihood that the price will skyrocket within the first week of trading, buying is a tempting proposition. But at the same time, such demand may be fleeting, and the stock price could just as well drop off and eventually stabilise at a price much closer to its original estimate of around $75 to $85 a share. This makes me lean towards holding off, but of course, you never quite know what will happen with the stock market these days. So what about you? Will you be buying, dodging this stock, or waiting to see what happens? As always, feel free to discuss in the comments below. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.